Well, good morning. We're going to talk today about biotechnology venture capital. Last year, biotechnology companies raised $23.6 billion in venture capital, according to William Blair. One way to look at that is to say that venture capital funding remains well below where it was during the peak year of 2021, when companies raised $35.6 billion. Another way would be to regard 2021 as an aberration and look at 2024 as a pretty strong year for venture investment relative to historical precedent. But there's no doubt that venture capital investment in life sciences is evolving, and we have a highly experienced panel of investors today who can provide us with a lot of insight into what venture capitalists are looking for in an investment, how they operate, and the big picture trends that affect the innovation ecosystem. So I'll introduce them and we will get started. To your far right, we have Brett Zbar. He is Managing Director and Global Head of Life Sciences with General Atlantic. Next, we have Allyson Rinderle. She is Managing Director with Bain Capital Life Sciences. Next, we have Nancy Ondovik. She is Principal, New Company Creation and Venture Investments with JJDC, which is Johnson & Johnson's corporate venture capital group. Next, we have Bong Koh. He's Managing Partner with Venrock, and closest to me is Hyung Chun. He is Partner with Foresite Capital Management. So, since we're here at Yale, I thought it might be good to start with a discussion about university-based innovation and the importance of that for the healthcare landscape and the investment landscape. So, Brett, I was hoping you could get us started by just sharing some thoughts about the innovation landscape you see at universities today and how that affects the investment landscape.
Sure. Thanks, Brian, and thanks to Yale and the Yale Ventures team for having us here today. It's a privilege to be here. So you're really starting us out on certainly a topic that's on many of our minds in terms of funding for research at many levels, both at the university level and NIH. And of course, those are very tightly tied together. When we look across the portfolio, we've got multiple companies where really their foundational IP comes out of the university environment. So it's an incredibly important part of our ecosystem. It's something that we're watching very closely. And I think as we look ahead, we've seen efforts to make significant changes in this ecosystem that have come back to the center, let's say, and that's what we're hoping for in the current environment.
Mm-hmm. And it's interesting. I read somewhere that over a quarter of approved drugs over the last kind of decade or so have come from an academic innovator, and so I think it just speaks to the importance of this space, and so it really is a lifeblood. And if you think about kind of NIH funding today and then over the future, there's the today impact, then there's the impact in 5 years and 10 years, so the longitudinal impact, and thinking about that, I think it's also incredibly important.
Yeah, just to add to that, I mean, I'm a BD person at heart. I spent 20 years doing business development deals, and I truly believe like no one can do it in isolation. You need innovation being funded and explored at NIH, and you need kind of companies that are well equipped and able to really deploy resources to get things across the finish line. And so if you don't have that faucet of innovation coming into the funnel, you won't see it right away, but eventually you will get to a point where innovation stalls and you don't get the growth that we've seen over the last 50 years, certainly.
Mm-hmm. Yeah, we've done a lot of work trying to quantify what this impact means. There's been a study done of the impact of the NIH, which is where obviously a lot of the funding cuts are. They say that over 90% of FDA-approved drugs have a biological underpinning or understanding that originated from NIH funding. Something like 7% of all university patents of FDA-approved drugs, and 38% of new molecules synthesized of FDA-approved drugs were happening in the university setting. So this is really clearly not good for the overall sector. But the one thing to point out is that not all hope is lost. Is if you look at the total R&D spend within biotech, NIH is just a portion of that. So for example, there's over $250 billion spent by pharmaceutical companies R&D. When you look at venture public financings, and then there are NIH equivalent institutions outside. And so while NIH plays a key role in addressing a major market failure, which is understanding biology, which is not terribly profitable, right? Not all hope is lost.
And I'll just add my 2 cents here with a real life tangible example. So many of you in the audience might know of a drug that got approved recently for non-opioid pain control called Jornavex from Vertex Pharmaceutical. It's a pain drug that's used for acute pain, approved for acute pain at the moment, that targets a sodium channel called NaV 1.8. And close home to Yale here, the first ever, I think, genetic mutation in human who had NaV 1.8 mutation was identified by Dr. Steve Waxman, who's a faculty at Yale. And that was about 12, 15 years ago, published in PNAS, and now that's turned into a drug. So it's a real life example of how this academic innovation really can turn into a meaningful drug that impacts society.
Right. And Bong, kind of picking up what you described as NIH funding is one aspect of the innovation funding ecosystem. It's not the only aspect. And with the direction that federal funding is taking for research, what is the impact on the relationship between investors and academic entrepreneurs, and also between corporations and the academic world? What is the evolution going to be like in your view?
I'd say if this was the only thing happening within biotech, I feel like it's an opportunity for early stage venture firms, for biotechs that are highly innovative to really partner and step up and fill that gap. So I think that will happen to some extent. Unfortunately, and I'm sure we'll talk about this in a moment, we're looking at possible major structural changes to our industry. And I'm sure, again, you'll address that later. And so the ability of these, private entities to really step up is going to be hampered because of what's happening overall to funding and the markets, et cetera. But there will be some filling of the void, in my opinion. But it wouldn't be to the same extent that you would have seen in other kind of more normal biotech markets.
Right. Nancy, anything to add?
Yeah, maybe just to add to that, I mean, if you look at NIH funding, grant funding, the lines are blurred between, what is a private company trying to advance something, getting venture funding versus getting grant funding as, an early source of their ability to advance things to a point where they can get venture funding. And I think in the current environment, early stage companies have been challenged. We've seen a number of them challenged to raise venture funds. And so, without that option, it does worry me a little bit that, again, we're feeding we're always feeding a cycle of continued innovation because most things will fail. And so if you don't have that, the plethora of new ideas coming in, you will start to see less innovation and then, lots of other changes happening on the later stage side with, the Inflation Reduction Act and other policy changes. And so, if you don't have kind of the full continuum of incentives for people to come in and the funding that's there, it could create an issue over the long term.
Mm-hmm. Allyson, anything? No?
I mean, it's also interesting. There's, academic innovation in the U.S. and there's also worldwide too. So, what is the response from the rest of the world, and what is kind of the opportunity for academic innovation in Asia and Europe and in other regions? So I think that will be something that we'll have to watch over time as kind of the situation evolves in the U.S.
Yeah. Just one other thing I'd say is that I think we are seeing a change in the ecosystem, and I think it's also reasonable to address the idea that not every project necessarily needs to become a company. And I think we are kind of entering a period which is not all bad, where we may, as a collective, may be more selective about what projects, what pipelines we create a company around, which of course has infrastructure around it and cost, et cetera. And so we may see just more different kinds of financing of those projects to become more advanced before we actually form a company around it and take on all those associated expenses.
Yeah.
I think that's actually a good thing for the industry. Like, I actually think the number of companies kind of today in biopharma versus in the early 2000s has dramatically increased, and that has implications for competitive intensity, kind of where that capital can be allocated. So I actually think if it results in some increase in focus on capital efficiency, number of companies, et cetera, that could actually improve the overall health of the industry over the long term too.
Yeah, there's certainly the belief by some people that scarcity can be good for innovation, and that great companies are often born in difficult times. And would you agree with that, or generally, or yeah?
Fully.
Fully.
And I'm not sure it's as much that great companies are born in difficult times, but great companies survive difficult times. And Allyson, you alluded to this, I think, and a critically important part of that is really around capital allocation and prioritization within projects. In many ways, it's been the bane of our sector. Seeing projects that are either undifferentiated or poorly differentiated from many other projects in the space. A lot of people in the room are probably aware of the fact that at one point we had well over 400 clinical trials in this country, all directed against CD19 cell therapy trials in one way or another. Nobody has the perfect answer, but we know that's not the right answer.
Yeah, with too much capital comes a dilution of good decision making, because people don't have to make choices, and strategy is all about choice. And I've seen this time and time again when funding environments are good, people aren't making choices. And very often these companies have choices that are clear, like this is clearly your best thing, this is what you should be going after, but then they end up doing everything. So there's a dilution of decision making. And then I think there's a dilution of talent. When you have so much capital out there, right? I mean, all of us have seen this like several years ago. It's like so hard to find talented people. And so you get a dilution of really talented people across many different companies. When funding is tight, they tend to be concentrated. And great things happen when great people come together and generate ideas. And so that getting away from that trend, I think, is another reason why you see some great companies being formed during times of stress.
Yeah, I think overall, bubbles are not good in almost every situation that you look at, right? And if there's so much money available that you're funding just too many ideas in the same space, you're competing for people, for experts, for patients. Ultimately, you're setting it up for everyone to have a more difficult time and potentially fail. So I do think, you have to look at the positive side of where there's less resources. You must be, laser focused on what's going to get you to that next really, proof point for you, and set the bar for anything else that wants to compete in that space.
We've been looking at things from the company side too, but if you look at it from the investor side, it also helps to, when times get tough, sometimes capital goes away, but that environment actually then helps draw new capital in. So you have less competitive intensity of lower valuations, and so that presents opportunities for new capital to come in and fund kind of the most promising opportunities as well. So I think it creates kind of a balance which helps kind of create kind of a very sustainable environment in the future.
And when capital is difficult to come by, what are some of the strategies that you talk to your entrepreneurs about for running a very lean, very efficient company that still meets all its milestones? And what are some of the things that come to mind that you can employ?
I can start there. Speaking from the corporate ventures capital side, strategic investors and partnerships that don't kind of give away the whole company. I think there's a way to use partnerships to validate, platforms or validate your approach that gives away, a piece of it, but also you get something in return, which, sometimes is proof that your mechanism, your platform can actually deliver on someone else's dime, and funding through partnerships, all of those things kind of strategic partnerships with other companies that are kind of in the same boat. You know, how can you help each other out? I think is one way to look at it. You know, but it has to be done in a thoughtful way so that you're not partnering kind of the whole company away. And then the other piece, you know, as a strategic investor, you know, someone like a J&J or other corporate venture groups can bring value to a company beyond just the capital, access to R&D, access to, you know, the latest thinking on, you know, what is the key piece of data you need to either, you know, go in one direction or prove your mechanism. So I think looking at alternate sources of capital, sometimes when there is a lot of venture capital flowing in, strategic investors are less attractive. You know, sometimes there are thoughts that, you know, that makes it less attractive from a competitive auction if there's a sale. But I think at the end of the day, as an investor, you know, we always have the company's, we have fiduciary responsibility to the company. And so ultimately, I think you can make sure you structure it to get something out of whether it's a partnership or a strategic corporate venture capital investor.
I think from execution perspective, there are ways you can get to the goal line, but you know, pursuing strategies to save costs, like for example, clinical trials in U.S. are, you know, would be quite more expensive than running the same kind of a trial either in Asia or even New Zealand or Australia. So I think many of the companies in our portfolio are pursuing strategies to run some of the earlier clinical trials in ex-US sites just to save costs and get to the data that they need without compromising the outcomes. So.
Yeah. I'd also say if you're thinking about this like when you're mid-flight, it's already too late. Mm-hmm. In other words, you know, I think it's really important to spend time as you're raising capital and thinking about your timelines and value inflections in the future, that you give yourself just enough optionality. So when things go off plan, as they inevitably do, you have different levers you can pull to reach that value inflection. You're thinking about, you know, who are the investors coming in? Do they have adequate capital to fund an inside type round if that's what's required to get there? Those are all components.
It's also interesting, I think, when cost of capital was lower, more companies were choosing to, for example, vertically integrate or, you know, pursue business models that were more capital intensive. And as cost of capital has increased, you know, thinking about, do you really need to own something? Can you outsource something? Do you have to build it internally? And I think to Brett's point, like part of that does, you know, require a proactive kind of decision around what's the business model, kind of what are you going to pursue? But I think that will be important, particularly for some modalities that are more capital intensive.
Right. And we've been talking a lot about scarcity, but one trend we saw last year especially was a proliferation of venture capital financings of 100 million or more. And according to William Blair, mega rounds were 42% of biotech venture rounds last year, which is abnormally high, but still high percentage. And I'd love to hear your thoughts about what drove that trend and what is the impact that it has on the industry.
I think there are two big things driving that trend. You know, we've seen proliferation of just mega VC funds. There have been a number of funds that did quite well in the 2020, 2021 time period. And those funds have had no problems raising capital. And you've seen fund sizes you've never seen really before in early stage venture capital. And so one reason why you're seeing those mega financings is they have a lot of capital to deploy. The amount of work you spend on a $10 million investment is almost the same as the amount of money you spend on a $100 million investment. And so from just a time efficiency, like being able to deploy the capital, that's one reason. The second reason I think relates to just crossover financings. So we do a lot of crossover financings. And when we do these, our goal is always to syndicate it with the blue chip group. So we spend a lot of time, blue chip groups, we spend a lot of time just talking to other investors and making sure that the company is well capitalized. The reason why we do this is twofold. One is to make sure you get to your major inflection point, and two is when you go public. It's very clear, you know, over the last 10 years, especially over the last 5 or 6, 100% of near 100% of IPOs have had a crossover financing. And when you look at the ones that trade well, almost all of them have a deep group of well-respected blue chip investors backing it. So I think that's one of the reasons why you're seeing this rise of these kind of mega rounds.
I also think having that amount of capital is itself inherently de-risking. We know we're in a cyclical sector. You don't want to get caught at a place where you need to raise capital and there's very little receptivity to your idea or fundraising in general. And so there's strategic value in raising those larger rounds as well.
Yeah, I'd be interested to hear from other investors if part of that is risk aversion to very early stage investing versus asset-based investing. I mean, we've seen a number of companies being formed with massive financing with assets that are being licensed from China. Those are later stage assets in clinical development, are inherently more expensive to get to the next inflection point. And so, if there's a desire to de-risk your investment strategy, go later, by definition, that just requires larger financing rounds.
And I can certainly see the argument for large financing rounds because companies do need the funding to reach inflection points, and a good balance sheet lets them focus more on execution than fundraising. But is there any downside to mega rounds? Is there anything to watch out for?
I think it's important that there is an important discussion around capital allocation and capital efficiency, and that's kind of disconnected from the capital availability. Because sometimes when people have a lot of capital, they just end up spending more rather than really thinking what are the critical kind of experiments, things that you need to do to get to a key value inflection point. I think what you've seen in the industry is that cost of development has increased, and it's hard to kind of separate that from the indications being pursued and other things. But I do think costs have gone up, and so really thinking about how do we make sure that there's a mentality of efficiency, that people are laser focused on, what are the key experiments, what do you need to get there, and not having excess. And so I think one of the downsides of having the larger capital is that there is a risk of spending more when you could be more efficient.
Yeah. Anything to add to that?
Yeah, I mean, I think just being cost conscientious, I think sometimes with such a large pool of capital, I think can be difficult to manage, but certainly I think something that I think we try to encourage our companies to be, regardless of the size of their financing.
We touched on this a little bit already, but I just wanted to bring it up again. The focus in venture capital lately has been on biotech assets as opposed to platforms. But I was wondering, are platforms still attractive in this environment, or what kind of models would still be viable even in a difficult?
We love platforms as long as they come with assets.
Yeah.
That's true.
Or platforms that have already resulted in an asset that can lead to more assets down the road. Yeah, yeah.
So is that the standard now? There has to be some kind of proof already in
I think it reflects the evolution stage a little bit. We invest in both platforms and asset-based companies, but ultimately we're underwriting specific assets, even if it is part of a platform. And so having kind of, the maturity of the platform where you're having some output of that you can evaluate, I think is more important in this environment.
Yeah.
And I think that's, even if you look at some of the most expensive headline type AI drug discovery companies that are clearly platforms, you'll hear them talk a lot about value creation through their pipeline and assets in the future. So to your point, Brian, I do think that is a little bit the paradigm. It's very hard, I think, not just in the current environment, but for the foreseeable future, to value platforms on the basis of the platform itself.
Yeah. Platforms are. I'm sorry.
No.
Yeah, no, platforms are definitely a risk-on phenomena. We've seen this through multiple different cycles over the last 20, 25 years, is that when risk is on, this is when these become popular because you can go public now when you're preclinical. I mean, the number of preclinical IPOs in 2021 was absolutely staggering, right? So platforms are super attractive at that point because you don't have to wait that long to get to a big major uptick in valuation. I think the other issue that happens and why it's easier to fund platform companies when risk on is happening is we have more capital to deploy as investors, and valuations of later stage assets become high. And so you naturally tend to move down kind of that that development cycle because you feel like you're getting a better deal. And so, of course, there are going to be some good platform companies that emerge during this time period, but really to see a true emergence of that, you really need risk on capital return. And given the macro headwinds and the structural challenges of biotech, it's hard to see that happening anytime soon.
Yeah. And Nancy, you touched on a little bit about this earlier, but just to revisit the point about engaging with strategics, what are some of the key considerations for entrepreneurs to be thinking about how to engage strategics, when to engage them, developing a kind of a vision for what that collaboration will look like? So.
Yeah, I mean, the first thing I would say, and this not only applies to strategics, but to any venture investor, is kind of know your audience. Are you talking to a group that is likely to invest? You're aligned as far as the type of investments they make, the spaces, the stage of investment. So kind of know your audience. Strategic investors or corporate venture capital groups can be very different in how they approach investments. For example, J&J, we're on one end of the spectrum where we only do investments that are strategic to our business. So if we don't have internal championship and support of a platform, an asset, a technology, a team, an approach, then de facto, it's not something that we're likely to invest in. So if you reach out to investors and you look at strategics, kind of know what their investing profile is, what their requirements are. There are other corporate venture capital firms that are completely independent of the business and in fact maybe counter strategy to the existing business. So they're looking at things that could be either new areas of investment or they're making kind of offsetting bets. So know your audience is, I think, the most important thing. So you're putting your energy into the right folks that are most aligned with your area of interest or your objectives as far as stage and dollars. And then I think be open to some level of influence or partnering as part of a venture investing because it can bring more than just dollars into the company. I think, insights eventually, if your exit is M&A, if your exit is, a large partnership, you're going to need to have a data package that is, a certain level of studies completed to a certain rigor. And so if you can get that insight and input early, that helps you set yourself up for success.
Mm-hmm. A word of advice I got from a strategic BD head at a large pharma is that I think they want to at least get to know the company and the potential asset early on, just so that they can develop a relationship and get to know the program over time. I think even if the first interaction may not be anywhere close to any transaction happening, but that developing that relationship early on, and as the program advances, there may be changes in the company, in the strategic's interest that it's better to have gotten to know them before, rather than just getting to know them as soon as you're hoping to make a transaction.
Mm-hmm. Yeah, I think that's a critical point. And in general, just early and frequent interactions with multiple strategics is helpful, because I think companies start to develop or understand the themes of feedback from those entities. And often they're going to be thinking about the same things. And that in turn helps you tune the proof points that you're trying to reach.
Mm-hmm. And sometimes we see option agreements when companies reach certain milestones. Triggers an option for the strategic to make an acquisition. Any thoughts about that model, when it's attractive, when it isn't? Or?
You mean in terms of tranche deals, or?
Well, sometimes there are like build to buy kind of agreements where a startup will engage with a strategic, and when that company gets to a proof of concept or certain milestone, then triggers an option for an acquisition.
Yeah, it's a good question. I think in general, the only issue with build to buy kind of pure build-to-buy structures, where a company's coming in and says, if you do X, we're going to buy you for Y, is that really at the end of the day, there's nothing stopping that large company from saying, well, we recognize that you did X, but now we're really only willing to pay you half of Y, sorry. Because, and it's contractually, there's no issue with that, because that they can also just not buy it. Yeah. And so we've seen situations where companies can end up stuck despite good intentions when initially striking that arrangement. So in general, it kind of comes back to trying to maintain optionality, because again, once you've made that kind of, once you put that kind of construct in place, it makes it very hard to raise capital or think strategically elsewhere.
Yeah. There's like building on what Brett was saying, a signaling effect as well. So if that group does not buy you, then everyone says, well, why didn't they, right? Like, and so like, is this damaged goods? Are they not good? So like, I think you have to be careful when putting them in place in terms of, if that does not work out, like what are your alternatives and what is the fact that that option not being pursued, what does that say about the opportunity to others? Yeah. And by the way, they can be great assets still, but like, I think there's just a signaling effect you have to work through.
Yeah. It's something I've, because I do a lot of assessment of company creation, of spin-outs of J&J assets, and it's something we encounter quite often when we go out to the market. Are the pressure points between our internal R&D groups that are spinning out assets and the venture investors that we need to come in with us, as far as they're willing to put the capital in. They don't want to cap the upside. And that's been the consistent kind of feedback we've gotten over the last few years when we've been doing this in earnest, is capped upsides are generally, kind of two strikes against you as you're looking at a deal. So we try and avoid them. We try and make rights somewhat softer, kind of rights, first look at data, first ability to negotiate, as opposed to having kind of these fixed price options or doing build to buys, which inevitably, our investment also is hindered by if there's just a change in strategy, change in the marketplace, but the data is still valid. You have a company that is seen kind of as damaged because their most logical buyer, did not actually pull the trigger.
Mm-hmm. Speaking of keeping your options open, the biotech IPO market is largely closed right now. So when it comes to later stage companies, what other options can they be thinking about? Obviously there's M&A, but should they be thinking about reverse mergers or royalty financing or some other types of arrangements that keep the financing coming in? Any thoughts on that?
Yeah.
No, please.
I was thinking you can also stay private. You can just do a traditional private round. I think just the stage does not have to dictate kind of a path to going public. I think a lot of companies in this industry go public because it's a capital intensive industry, and going public provides a path to more access to capital. But if you're able to achieve that in the private market, and often be a very good and kind of viable path to move forward. I think, depending on the stage and also the setup. So if it's a platform company, like thinking about partnerships on earlier stage assets might be very attractive. If you just have kind of one lead asset, that's obviously probably less of an opportunity to pursue. And you could also do then kind of non-dilutive financing. I think the thing to think about there is, can your capital support the type of non-dilutive financing you're considering? So if you're thinking about debt, how much debt, what are the terms of the debt? From a royalty perspective, what terms can you get on that royalty depending on the stage of the asset, et cetera. So I think those are some of the considerations.
Yeah, I mean, we do a lot of reverse stock merger investments that are with concomitant pipe. So basically, a company that's private merges with the shell of a public company, and then you do financing on top of that. So that's been an increasingly popular option. We've also seen royalty financings. Royalty financings are pretty interesting in that, you are giving away you're taking asset dilution instead of equity dilution, but the asset dilution usually tends to be minimal and tends to get ignored by the street. The issue is finding someone to do that at an earlier stage, because even a later stage private biotech company is still relatively early by a traditional royalty pharma player. The other thing that we're seeing a big uptick in is just the number of acquisitions that are occurring on the private side. Most companies typically wait. I think if you're a later stage private company, I can tell you one of my big pet peeves is when they get acquired too early. I'm not going to say the name of the company. There's a company, had a term sheet in, we're building a great syndicate, and it got acquired for a spectacularly low price. And it would have done very well as a public company. I think if you're a later stage company and you're thinking about your different option sets, including M&A, you really need to understand the pressures of your board. Every venture investor has a different set of pressures that are unique to that individual and that are unique to that individual's firms. Some firms, for example, there's just an immense pressure to return capital to their LPs right now. And so what we've seen is when those are dominant on a board, they tend to get sold too early if they have a very promising asset. And so understanding the firm that your board member is from and understanding that individual's preferences, because sometimes that individual, their firm may be doing well, but they are not. And so they need to win. And so what I would say is, if you've got a very promising company and M&A is on the table, because companies are acquired, not sold, right? Which means there's been inbound interest to you, you're probably better off doing your private financing and just waiting. That's just my perspective.
Yeah.
One last point on the royalty side is, so we're investors. One of our significant investments is in Royalty Pharma, one of the leading providers of traditional royalties. And they've been very, very busy, as you can imagine, in this environment. And they and a handful of other platforms will look at clinical stage assets for royalties. And Bong, to your point, I mean, we've seen royalties getting done for phase 2 assets that have been, I think, very helpful providing capital midstream in clinical development. But it all depends on the biology and de-risking of the asset.
Mm-hmm. One big development we've seen in biotechnology in recent years is the emergence of China. And I would like to hear opinions about what the emergence of China's biotechnology industry, the effect that it has on U.S. investors and startups and how they make decisions about investments and just building their companies.
I can kick us off. So, Foresite has been very active in looking at assets that are coming out of China that have made it through the preclinical stages and are about to be going into clinic or already in clinical trials in China. And I think this has led to a number of assets that are being out-licensed from the Chinese company into a new co that's formed in the U.S., where I think many of us around here would be investing in. Yeah. I think one challenge that has emerged in recent few years is that some of these assets that we are interested in also have caught the interest of big pharma. So, you see a lot of deals that are happening where early stage Chinese assets are being acquired by the Mercks and the Lillys and, and AZs of the world. So, that's a bit of a tough situation for us to compete against. But at the same time, I think a lot of those assets, there are quite a few of those assets to choose from. And I think sometimes, you can find a unique asset that is interesting to us and we can raise capital around. So.
I can imagine you wouldn't have the firepower of Merck or Pfizer, but what is the kind of value proposition that you kind of pitch to companies that are considering out-licensing outside of China?
Right. So, usually kind of the upfront offer to the Chinese company tend to be on the lower side than what the pharmas would be offering. But at the same time, the company that is formed around the asset would be laser focused on developing the asset, rather than if it gets acquired by a pharma, it may take the pharma longer for that asset to be developed. And also at the same time, there will be equity piece that is given to the Chinese company that may not happen in the case of a pharma acquisition.
Yeah. But,
Yeah, it's interesting. So just looking at the people on the stage here, Venrock, Bain Capital, and General Atlantic have each invested in a new co that's licensed assets in the metabolic field from China with the GLP-1 backbone, Metsera, Kylera, and Verdiva Bio, all of which we think are, these are companies with great assets, each of which have a place in this very, very large market. But I think it does speak to your point, Brian. It's very real. There's a lot of capital kind of that's flowed into this concept. It has gotten certainly more expensive, I think, as large pharma has gone direct. And so I think that's resulted in a slowdown of activity recently. But certainly we expect to continue to see important innovations coming out of that ecosystem.
I think one of the most useful things to look at when thinking about China is really just numbers. And it's, if you look at, for example, licensing activity. So if you look at the number that are happening and then the prices being paid, I think it gives you a lot of insight onto what is happening and what is about to happen. So if you look at like later stage assets, for example, in terms of the number of deals happening, it hasn't actually changed all that much over the last couple of years. And Brett and I were talking about this last night. There's this feeling, I think, among investors that a lot of the better later stage assets have kind of been picked over. Obviously, there's going to be more continuing, but a lot of that's been picked over. I think when you look at earlier stage stuff, that has skyrocketed and it continues to climb. And I think that tells you that the innovation is real, that there's real science happening there are real companies working on science, et cetera. I think the other interesting thing when you look at the numbers is like prices are going up and deal sizes are getting bigger, right? And that tells you a lot of people are looking. So when you look at this overall trend, it is concerning to the U.S. early biotech ecosystem. But I think there's one important set of numbers to keep in mind, and that's venture capital funding within China. So U.S. venture capital funding has dropped, obviously, over the last couple of years. It has plummeted in China. And those are the firms that have been funding these innovative companies that have led to everything that we're seeing currently. I believe if we don't see a substantial uptick, right, in the level of investment that these local firms are making, I think it could diminish the overall threat over the long term of China. That being said, we'll see what happens. It's unclear to me with these deals that are happening is how much is this helping these local kind of venture firms within China? Are they actually generating good returns? Are we actually going to see a return of private funding within China? Because if not, I would say, well, longer term, it's less of a concern. So I think an important leading indicator to look at is just what's happening overall with the financing environment there, because it has not been good.
Yeah.
I also think we've seen, despite the fact that there is real innovation occurring, there's also still a massive amount of very similar programs across a very large number of companies. This has been extensively kind of written about to the point where we've taken a look at a number of different therapeutic areas and indications and just said, like, there's just too much. We're not gonna be active here.
I think putting yourself maybe in the shoes of some of you who are, coming from a company perspective and thinking about where can you innovate where there'll be less competition from China. I think a couple of things. One is thinking about the modality. So if you have a monoclonal antibody and you're going to hit a target with it, they're going to have very fast followers in China, and it's very easy to make small tweaks and have not hit IP. I think some small molecules, it's hard to kind of achieve the same profile and not impinge on IP. So there's some things to think about. Focusing on novel biology can help protect you, kind of staying in stealth mode for longer. So there's less opportunity for others to quickly follow where they are able to move quickly. So I think those are some considerations as you think about the response to the increase in competition in China.
Yeah. We have some time for questions from the audience. Anybody have a question you'd like to ask? Yeah. We have.
A lot of people and investors have been talking about biotech cycles as if they were exogenous to investors' own decisions. And so I was just interested in your opinions on why perhaps you guys or others are decreasing investment right now or increase it in other points of time. And when people talk about, during ruts we try to get fit and look at only the best assets, but then in other areas where IPOing early kind of preclinical stuff, what drives that difference in investor behavior and willingness to fund different things?
I can chat. The biotech has been super highly correlated to interest rates over the last several years. It's always the case that interest rates do impact biotech investing behavior. I'd say let's just ignore what's happening structurally with biotech right now. I'd say in these times you just see a decline in investments overall. There are firms that are more value oriented that kind of step in. For example, we in typical times like this start stepping in. We have a lot of capital to deploy. We're very well capitalized right now. But that is not happening right now, for us at least. And the biggest reason why is just the structural issues facing biotech right now. I've said this before, we believe there are three pillars to biotech. There's innovation, there's regulatory, there's drug pricing. Every one of those pillars right now is being impacted. We've talked about innovation already. We haven't talked about FDA and the regulatory changes there, but there's a clouding, right, of what exactly is happening there in terms of decision making. And lastly, the single greatest issue is just MFN, right? What is that going to happen? How is that going to play out? When you layer these things together on top of the macro headwinds, we're seeing just a dramatic pullback just across the board of other investors investing. It's not just us right now. And so for us, this normally would be a time to lean in because you're going to get some great deals. But I think without certainty on the structural front, it makes it very difficult for everyone across the board, including firms like us that are historically used to leaning in. And if you ask me of those three pillars, what is the single most important one that we need clarity on? It's MFN.
Hi, Ben Zeskin from Immuneering. Thanks for a great panel. Don Valentine, the legendary founder of Sequoia, famously said, the key to making great investments is to assume the past is wrong and to do something differently, completely differently. So I'm curious how you apply that kind of philosophy in a challenging market, right? How do you, how do you sort of challenge the conventional wisdom even when there's sort of this risk-off environment? Curious for your perspectives there.
Well, maybe like a broader, I kind of agree with the comment, and I think like independent of the cyclicality of the market, I think, I always think about you don't invest what's already hot, you invest where, you think it's gonna be hot, so where the puck's going, right? That's always where the investment opportunities lie. With regard to this environment specifically, I mean, obviously, when others are deciding not to invest, that presents an opportunity with regard to decrease in competition, ability to have perhaps more attractive valuations as you think about opportunities. I do think, this moment is also impacted by a number of uncertainties. And so, you probably won't have certainty even in the next month where there's going to continue to be uncertainty. So you have to act in a period of uncertainty. And the question is, how do you do that? Are there opportunities that are more protected? And so I think looking at those areas for which there are uncertainty and seeing where you could perhaps have more areas of protection. For example, we're going a bit later stage where some of these uncertainties are mitigated, but it'll still allow us to think about deploying capital.
Yeah. Hey, Ben, congratulations on the recent progress at Immuneering. It's exciting.
Thank you.
So it's interesting. I think it's true in a lot of sectors, especially in our sectors. I mean, the past is always wrong. I mean, if you look through the cycles we've gone through with cell therapy, which was going to cure everything, and gene therapy, which was then going to cure everything that cell therapy hadn't cured, and then what we've gone through over the last several years with AI and drug discovery and some of the proof points that are still outstanding there. I mean, we've seen again and again going through these cycles. So I think for many of us, we're constantly thinking about how not to get caught up in that next one. In addition to Allyson's excellent point about where the puck is going. I think in addition to thinking about it through that lens with the science, it's also very much relevant to where funding is going to come from and the funding models, which we've been talking about for a lot of the morning.
Thank you.
Speaking of AI, and apologies, I was a few minutes late, so if you covered this already. Okay. I was just curious, from an AI perspective, is that changing how you make your assessments about where to place your investments? Is it changing anything about your process, how you look out towards the future, in terms of how you're incorporating that into your businesses?
I mean, I can tell you, we are actively engaging. Coming from a big company, it takes a little bit longer. So I'd be curious to see if some of the venture funds are already there. But we are trying to actively use AI to make our processes, our assessments, our monitoring of investments and new investments more seamless. So we can do more, with existing resources. But I would say, we're probably behind, slower adopters than others. So.
Our companies have been focused on what today are practical applications, or what we see as practical applications. So one of our portfolio companies, Vi Labs, uses large data sets and AI to assist with clinical trial recruitment, for example, and also very targeted patient engagement on the commercial side.
I think from incorporating AI into our kind of daily practice, I think we do that, more than we did a few years ago into kind of our kind of diligence process as much as it can help to expedite how we diligence companies and investments. I think from investing in companies, using AI to develop new drugs, I think, that's, I'd love to kind of see that AI, demonstrate capacity to save time and to get to a safer, more efficacious asset down the road. And I think, many of the first earlier generation AI companies, I think have not proven out as well, but hopefully the later stage AI companies that are emerging, including some that we've invested in recently, will make a difference.
Sorry, your question.
Okay, my name is JJ, and I come from the Synvest Imaging. So we are the radio pharmaceutical company startup. So I wonder, during your life of the investing, do you have any moment that you decide to invest or not invest besides the key data you want? I mean, like most startups will not go into the clinical trial right before or fundraising stage. So is there any moment you have to invest this team or invest this assets or the technology?
Sure. Just one example. One of our portfolio companies, Solve Therapeutics, is an antibody drug conjugate focused company run by a team led by Dave Johnson, who had previously built and sold the company Velos. That was also a Foresite company. So when there's a team that we've worked with before and been successful with before, and a technology in which we have very high conviction, in which we do in the ADC case, yes, those are the situations where we tend to get involved at the earlier stage.
Hi, Moray Grassi, the Director of the Blavatnik Fund here at Yale. My question is about investment into earlier stage technologies. As Allyson mentioned, 25% of many assets come from academia, but with these huge mega rounds now, there are no small rounds. How long do you think this trend is likely to go? Is this a new trend that we're going to see constantly? And do we in academia need to adjust to find that, $500,000 to 5 million first check? Do we need to find other sources?
Yeah, I think a lot of assets are still coming from academia. So I haven't seen recent data in terms of trends decreasing. I think the increase in average size around is reflective of a couple of things that have been already pointed out in terms of capital availability, people funding through later points in value inflection. So people want to get through a round that gets to some clinical data, reflective of spending on more things at earlier stages. To the extent you're looking for smaller amounts of capital to de-risk prior to getting to that round, I think there is still an ecosystem of venture investors that would invest in that. Obviously, that's become a little bit of a tougher space, but then you can also think about non-dilutive financings. You can think about partnerships on certain programs. There's a range of other ways to advance and de-risk prior to a larger financing as well. I also think, by the way, I remember it wasn't long ago that a 30 million Series A was a very large financing too. So I don't know why today every round has to be 100 million plus. So I think that there's plenty of room for very important financings that will fund through value inflection points that are smaller in size as well.
Yeah, sorry.
Well, just to add, I think kind of there are different kind of, I guess, phenotypes of VC companies that would invest into kind of earlier stage companies versus later stage companies. I think the panel, broadly speaking, represents kind of more on the later stage side, But when I was faculty at Yale until about 4 years ago, the type of VCs that I would speak to about ideas that were coming out of my lab were kind of more tended to focus on the earlier stage company creation side. So there are a number of those companies, number of those VC firms around. So those would be perhaps ones to kind of focus on engaging in dialogue early stage on. So.
Yeah, I think there's been a rise of the mega round, but smaller financings are still happening. Like our early stage team is still very much doing deals like that. I also think market inefficiencies tend to get removed over time. That length of time can vary. It wouldn't be surprising if we see a proliferation of incubator funds, right? People filling that void, raising capital to target earlier stage where there's now a big gap and need that is being created. And so if anyone here has ideas, that's a fund you could start.
Yeah, and I don't know if I feel like there has been more and more smaller boutique funds kind of appearing. I'm fairly new to the venture world, but I feel like every couple days I come across a fund, a small boutique, or attend a meeting, and it's a group I haven't heard of previously. So they're out there. They're different profiles, and it goes back to kind of knowing who you are most likely to align with as far as investment objectives.
Mm-hmm. Great. So we are about out of time. So please join me in thanking the panel.